18 months. That's the window. That's how long you have to reposition your portfolio before the next massive transfer of wealth from the unprepared to the prepared. Not 2 years, not 5 years, 18 months. I've spent 30 years in global macro. I ran Gigi's global macro fund. I called the 2008 crisis before it happened. I've been inside the machine. Goldman Sachs, hedge funds, central banks, and right now every single indicator I track is flashing red. We're in the late stages of the biggest debt cycle in human history. The final stage doesn't just correct portfolios, it obliterates them. 50–60% drawdowns for anyone holding conventional assets. But it doesn't have to be you. There are 4 investments only for that survive what's coming, and in the next 20 minutes. I'm going to show you exactly what they are, why they work, and how to position yourself before this window closes quietly and permanently. Here's what the mainstream media won't tell you. These cycles happen every 75 to 100 years. The last one was the 1930s and 40 seconds, and when they end, they don't end with a whimper. They end with the largest wealth transfer in history from people holding the wrong assets to people holding the right ones. I'm going to walk you through exactly what those 4 assets are, why they're the only ones that preserve purchasing power when everything else collapses, and how to reposition your portfolio before it's too late. But first, let me tell you a story that explains why this matters more than anything else you'll hear this year. In 2006, I sat down with a friend of mine. Let's call him David. He was 54 years old, a senior executive at a multinational. He'd accumulated $2.2 million over 25 years of disciplined saving and smart corporate moves. He was doing everything right, or so he thought. 60% stocks, 40% bonds, blue chip wealth manager, paying $25,000 a year in fees for them to tell him to stay diversified and think long term. I sat with David over dinner in London. I told him what I'm telling you now. We're at the end of a credit cycle. Housing is a bubble built on structured products nobody understands. The banks are leveraged to the eyeballs. Something is going to break, and when it does, it's going to break hard. David didn't listen. His advisor told him I was being overly macro. They showed him backtests going back 40 years. They told him diversification would protect him. They said my concerns were alarmist, so David stayed the course. 2007 came. Markets kept climbing. David's portfolio hit $2.5 million. He started talking about early retirement. His wife found a villa in Portugal they wanted to buy. Then 2008 hit. David's portfolio dropped 52% in 14 months. That $2.5 million became $1.2 million. Everything he'd built over a quarter century cut in half. He was 56 years old. His advisor told him not to panic. It'll come back, they said. Just hold on. But David didn't have time. He needed that money to compound. The math doesn't work when you're 56 and you've just lost half your wealth. The market didn't fully recover until 2013. David was 61 by then. His retirement calculator showed he was $900,000 short. He pushed retirement to 65, then 67, then 70. I saw David last year at a conference. He's 73 now, still consulting. Not because he wants to, because he has to. The Portugal villa never happened. The early retirement never happened. His golden years became his working years. And here's what kills me. David wasn't stupid. He wasn't reckless. He followed the rules. He trusted the experts. He did everything conventional wisdom told him to do, and it destroyed him. The advisor who told him to stay the course retired at 55, lives in Monaco now. Don't be David. Let me explain exactly what's happening right now and why you have maybe 18 months to reposition. The economy is not random, it's a machine, and that machine runs on 3 forces: productivity growth, short-term debt cycles, and long-term debt cycles. Productivity growth is straightforward. Are we producing more value per person this year than last year? If yes, the economy grows. If no, it stagnates. Short-term debt cycles last 5 to 8 years. Expansion, borrowing, spending, overheating. Central banks raise rates. Contraction. Central banks cut rates. Repeat. This is why we see recessions every 7 to 10 years. It's not chaos, it's the machine cycling. But there's a third cycle operating underneath that most people never see: the long-term debt cycle. Over decades, debt accumulates: government debt, corporate debt, consumer debt, all of it building up year after year, and eventually you reach a point where the debt becomes mathematically unsustainable. You can't service it, you can't grow your way out of it, you can't refinance at lower rates because rates are already at the floor. That's where we are right now. Total US debt, government plus corporate plus consumer, is over $95 trillion. Federal debt alone is approaching $40 trillion. That's over 130% of GDP. The federal government now spends more than $1.2 trillion per year just servicing existing debt, more than defense, more than education, more than infrastructure combined, just interest payments, when interest costs exceed discretionary spending for the first time in modern history. That tells you something critical. The debt load is unsustainable. When you're at the end of a long-term debt cycle, you only have three options. Option 1, defaults. Governments, corporations, individuals stop paying their debts. Bankruptcies cascade, massive wealth destruction. Option 2, restructuring. Debts get renegotiated. You owed $100. Now you owe $50 paid over 20 years. Sounds reasonable until you realize if you're the lender, you just lost half your money. Option 3, inflation. Print enough money and the debt becomes worthless in real terms. You owed $100,000 in 2020. By 2030, that same $100,000 is pocket change because the currency has been debased. Great if you're a debtor. Catastrophic if you're a saver. And guess which option central banks always choose? Inflation, every single time. They'll never admit it openly. They'll call it quantitative easing, or stimulus, or monetary accommodation, or whatever euphemism sounds less terrifying. But it's money printing, creating currency out of thin air to devalue the debt. And when they do that, the dollars in your bank account, the dollars in your retirement accounts, the dollars you've been saving for 30 years, they buy less, a lot less. I've studied these cycles obsessively. I've mapped every major debt restructuring since the Dutch Empire. The pattern is always the same. In the 1930s, it wasn't just stocks that got destroyed. Government bonds defaulted, corporate bonds collapsed, stocks dropped 89% peak to trough. The only people who preserved wealth were the ones who owned for specific types of assets. In the 1970s, the same pattern repeated. Bonds got eviscerated by inflation. The 10-year treasury lost over 60% of its real value from 1970 to 1980. Stocks went essentially nowhere for a decade, and when you adjust for inflation, which ran 7 to 13% annually, real purchasing power for stock investors declined by over 50%. Someone who bought stocks in 1968 didn't break even in real terms until the early 1980s, 13 years of zero real returns, 13 years watching purchasing power evaporate while advisors said stay the course, but four types of assets exploded. Gold went from $35 per ounce to $850, a 24x return. Businesses with pricing power like energy companies saw revenues increase 700%. Short-term treasuries protected capital and provided optionality. Agricultural land doubled and tripled in value. The pattern repeats every 75 to 100 years. When debt cycles end, paper assets collapse. Only four types of assets hold value. Let me tell you about someone else, a woman named Caroline. She reached out to me through Real Vision in 2012, 3 years after the financial crisis. She was 66 years old. Her husband had passed away the year before. They had saved $1.6 million by the time he retired at 64. Their advisor put them in a typical balanced portfolio, 70 stocks for growth. When 2008 hit, they lost over $700,000. Her husband couldn't handle it. He would wake up at AM checking their account balance. He stopped sleeping properly. His blood pressure spiked. His health deteriorated rapidly. Caroline wrote to me because she wanted other people to understand something. The real cost of following conventional advice isn't just money. It's years of your life. It's your health. It's watching someone you love suffer because they trusted the wrong people. She said if she could go back, she would trade every dollar of potential upside for the peace of mind that comes from owning truly safe assets. Don't let this be you or someone you love. The 4 investments that survive. Investment number 1. Physical precious metals, gold and silver that you own and control. Not gold ETFs, not mining stocks, not paper gold. Physical metal you can hold or that's allocated to you in a secure vault. Here's why this matters for your portfolio. Throughout history, every time a currency collapses, gold survives. It's the ultimate insurance policy against monetary incompetence. In the 1970s, when inflation destroyed everything else, gold went from $35 to $850. Someone who put $10,000 into gold in 1970 had $240,000 by 1980. Someone who put that same $10,000 into the S&P 500 had maybe $12,000 after inflation. In the 2000s, when the housing bubble burst and central banks printed trillions, gold went from $250 to $1,900, nearly an 8x return. In 2024 and 2025, gold went up over 50%. Silver went up over 100%. The market is already pricing in monetary stress. Physical gold and silver should represent 10 to 15% of your liquid net worth. Store it in secure vaults across multiple jurisdictions. You hope you never have to use it, but if the dollar loses 50% of its value over the next decade, that gold doubles in dollar terms while everything else collapses. It's not an investment. It's insurance. Insurance always has a cost. In good times, gold underperforms stocks. That's fine. That's what insurance does. It's there doing nothing most of the time. But in bad times, when your stocks and bonds are getting crushed, gold holds steady or goes up. That 10 to 15% allocation could be the difference between retiring comfortably and working until you're 75. How to buy? 1. Buy directly from reputable dealers like APMEX or JM Bullion. They ship to your home or arrange. Vault storage. 2. Use allocated storage services like Bullion Vault, where you own specific bars stored in secure facilities in London, Zurich, or Singapore. 3. For those outside the US, consider the Perth Mint or similar government-backed facilities. Start with 1-ounce gold coins, American Eagles or Canadian Maple Leafs. For silver, consider 10 ounces bars or 1-ounce rounds. Expect to pay a premium above spot price, typically 3 to 5% for gold. Never buy numismatic coins marketed as collectibles. You want bullion, pure metal, nothing fancy. Investment number 2, businesses with pricing power, not stocks generally. Not index funds, individual businesses with 3 specific characteristics. 1. They can raise prices faster than inflation. 2. They generate cash flow you can live on. 3. They own hard assets or intellectual property that holds value when currency is being debased. In the 1970s, when inflation ran 10 to 15%, most stocks got destroyed. The S&P 500 went essentially nowhere, but certain companies exploded, energy companies that owned oil and gas reserves when oil went from $10 a barrel to $80, their revenues went up 700%, their costs went up maybe 50%, massive profit expansion. Utilities with regulated returns when their costs went up, regulatory frameworks let them pass those costs through to consumers with a guaranteed margin. Johnson & Johnson owns Band-Aid, Tylenol, medical devices. When inflation hits, hospitals don't stop buying medical equipment. They pay the higher price. These aren't get-rich-quick plays. These are wealth preservation plays. When inflation hits, these companies don't just survive, they thrive. You should allocate 30 to 35%. 2 businesses with these characteristics, companies that own hard assets, have pricing power, and generate reliable cash flow. How to find these businesses? Look for dividend aristocrats, companies that have increased dividends for 25 consecutive years or more. This list includes about 65 companies. They've survived multiple recessions and maintained pricing power through every economic cycle. Focus on 3 sectors: consumer staples, Procter & Gamble, Coca-Cola, Colgate-Palmolive; utilities, NextEra Energy, Duke Energy, Southern Company; healthcare, Johnson & Johnson, Abbott Laboratories, Medtronic. Check their dividend history. A company that raised dividends every year for 30 years has proven pricing power. Check their payout ratio. You want it below 60%, which means they're not stretching to pay dividends. Build equal positions in 6 to 8 companies across these sectors. This gives you diversification within the pricing power bucket without overdoing it. This sounds boring, but it's actually the most critical position in your portfolio right now. 90-day to 2-year treasury bills earning 4 to 5%, cash equivalents, money market funds backed by treasuries. This is your dry powder, your optionality, your crisis ammunition. When the crisis hits, and it will hit, you want cash, because that's when the best opportunities appear. In March 2009, high-quality corporate bonds were trading at 60 cents on the dollar. If you had cash, you could buy them. 12 months later, they were back at par. 60% returns with minimal risk. In March 2020, when COVID panic drove stocks down 35% in 3 weeks, cash was king. If you could deploy at the bottom, you doubled your money in 6 months. The people who made fortunes in those crises weren't the smartest, they were the most liquid. Keep 20 to 25% in short-term treasuries and cash. It earns 4 to 5%, barely keeps up with inflation, but it gives you optionality. When everyone else is panicking and selling, you're buying. Right now, short-term treasury yields are the highest they've been in 15 years. You can earn 4 to 5% with complete safety of principal and full liquidity. This won't last forever. When the crisis accelerates, the Federal Reserve will cut rates back towards zero. That 5% becomes 1% or less. Lock in these rates now while you still can. How to buy Treasury securities. The simplest way is through Treasury Direct, the government website. Open an account for free. Buy Treasury bills directly with no fees or commissions. You can set up a ladder where bills mature every month, giving you regular access to cash. Alternatively, Use a brokerage account and buy treasury ETFs. Ticker symbol SCOV holds short-term treasury bills. Ticker symbol BILL holds 1 to 3 month bills. These trade like stocks but hold only government securities. For cash equivalents, open a money market account at Vanguard or Fidelity. Their treasury money market funds currently yield around 4.5%. Your money is liquid, you can withdraw any time, and it's backed entirely by treasury securities. Investment number 4, productive real assets, agricultural land, rental properties, infrastructure. Assets, farmland REITs, things that produce food, shelter, energy, things people need regardless of what happens to paper currency. In every debt cycle crisis, real assets hold value because they produce something tangible. During the 1930s depression, farmland values held relatively stable in real terms while stocks and bonds collapsed. Why? Because farmland produces food, and people need to eat regardless of what's happening in financial markets. In the 1970s, agricultural land doubled and tripled in value as food prices soared. Rental properties performed well because rents increased with inflation. Real assets have 2 characteristics that make them safe. First, they produce income. A farm produces crops. A rental property produces rent. That income stream continues regardless of what the asset is worth on paper. Second, they're tangible. You can't print farmland. You can't create rental properties out of thin air. Supply is constrained while demand for food and shelter never goes away. Allocate 10 to 15% to real assets. For most people, that means REITs that own income-producing properties. How to invest in real assets. Start with farmland REITs. Ticker symbol LAND is Gladstone Land Corporation. They own farms across the US and lease them to farmers. Current dividend yield around 3%. Ticker symbol FII is Farmland Partners, similar model. For residential real estate, consider Realty Income. Ticker symbol O. They own over 13,000 properties and pay monthly dividends. They've increased dividends for 29 consecutive years. For diversified real estate exposure, by Vanguard Real Estate ETF. Ticker symbol VINC. It holds hundreds of REITs across residential, commercial, industrial, and healthcare properties. If you have significant capital and expertise, direct ownership of rental properties or farmland is even better. But most people don't have the capital or time. REITs give you exposure without operational headaches. The complete portfolio allocation. So those are the 4 assets that preserve wealth during debt cycle crises. 10 to 15% physical gold and silver, 30 to 35% businesses with pricing power, 20 to 25% short-term treasuries and cash, 10 to 15% productive real assets, that's 70 to 90% of your portfolio in these 4 categories. They understand the problem. They agree with the analysis, but then something happens. Markets rise another 10%. They think, maybe I should wait, or they panic, sell everything, buy gold and sit in cash waiting for the apocalypse. Then markets go up for another year. They miss the gains. Their gold goes nowhere, and they feel like idiots. That's not how you do this. Here's the systematic approach. Step 1. Calculate your timeline. How many years until you need this money? If you're 35 and planning to retire at 60, you have 25 years. You can reposition gradually over 12 months. Sell that first, this week. Then trim your overweight positions. If you're 80% in index funds, start bringing that down over the next 3 to 6 months. Don't try to time the perfect exit. You won't. Nobody can. Just systematically reduce exposure to vulnerable assets. Step 3. Build the 4 buckets gradually. Month 3. Buy 2 more pricing power businesses, maybe a utility like NextEra Energy and a healthcare company like Abbott. Add more 2 short-term treasuries. Month 4, add physical silver. Increase your gold and silver allocation to 10% total. Month 5, add real asset exposure. Buy Realty Income or Vanguard Real Estate. ETF. Add 1 more pricing power business. Write it down. Make it concrete. Give yourself deadlines, a system, an algorithm. Something you follow regardless of what the market does, regardless of what the news says, regardless of how you feel. Because your feelings will destroy you in a crisis. Fear will make you sell at the bottom. Greed will make you buy at the top. Hope will make you hold positions that are going to zero. A system protects you from yourself. This approach has worked through every debt cycle crisis in history. 1930 seconds. 1970 seconds. 2008. The pattern never changes. Paper assets collapse. These 4 assets survive. The window is closing. We're in the late stages of the biggest debt cycle in modern history. In 6 to 12 months, we'll be in the crisis phase, and by then it's too late. The people who act now will survive. The people who hesitate will become casualties. It's that simple. It's that brutal. Turn off this video. Open your portfolio. Start today. because in 6 months you'll either thank yourself or hate yourself, your choice.